Well, welcome everyone to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money color commentator. On today's show, checking out our insurance companies for voluntary benefits. Part 4 in our series on voluntary benefits with nationally recognized voluntary benefit expert, Tim Martin. Welcome to the show, Tim.
Thanks, Steve. It's good to be here.
Well, I guess we got to check out the insurance company now, right? Because it's only your policy, your contract is only as good as the insurance company behind it.
That's absolutely right.
Well, I guess so. So this is a big issue, right?
It is.
Not only the strength, and we'll get into the financials and all that in a second.
Important,
but I'm really concerned more about claims paying ability. I mean, I want my policy, if it says they're going to pay it, I don't know, are they going to pay it? Is the service easy? Am I going to get it 10 months from now? Or am I going to get it right now? You know, I want to kind of know about that. So walk me through, because voluntary benefits, we're in morbidity land, not in mortality land. So tell me about claims paying ability.
Well, not just claims paying ability, but how quickly does that claim get paid? Most companies have pretty darn good claims experience for the consumer. Some of them don't. I won't name names, but there's a few that kind of have a reputation of dragging their feet and taking a while to do it. But just like you said, I want to make sure that the company's going to be around and they're going to have the ability to pay that claim as well.
I'm telling you, you know, with company online due diligence and due care companies like Yelp, which would be my first one to go. If you're not paying fast and so forth, you can get a bad rep pretty fast on the line.
That's absolutely right.
Okay, so speed is an issue?
Yep.
Paying the claims, matching it up to the contractual provisions?
Yeah, and how easy is it to file? That's, again, one of those things that, remember, we talked about it the other day, that these policies are paid after the fact. It's not you hand over your insurance card at the emergency room and it works that way. You have to turn in those records and get that paid. So a lot of the companies, again, we're living in the electronic age, they've got it so easy where you can just take a picture of the receipts from the emergency room from your doctor, the hospital, whatever, and file that way. And again, the older companies that aren't doing that, doesn't make them a bad company, it just makes it harder to file your claim.
You know, when they talk about when you're on the bubble, when there's some gray area, the policy doesn't actually spill it out perfectly.
Right.
Who pays fair? Does that become an issue then? Who's a little bit more benevolent to the consumer?
Well, absolutely, absolutely. You know, it is a contract, right? So they try to make most of the things black and white, but there are some things that just are hard for the carrier to quantify, right? And what I found, though, is the better carriers actually do pay those if they're able to. If it's not going to create a precedent that is going to create a problem down the road for them, they'll pay it. And I've turned in claims for some of my policyholders where I went, holy cow, they paid that? Because I didn't think they would, quite frankly, because it wasn't spelled out to the letter that way.
When I'm looking, I love that. I love benevolent contracts that have a little bit of elasticity in their interpretation. I love stuff like that. All right, now, how much do I need an agent like this? You know, you're looking for value added. Why am I buying from you, from somebody else? I thought once I buy this, I'm done. But no, you need to have an engaged agent.
I agree very much. I think that this policy was sold by that agent typically at the work site, right? At the work site. And you don't want an agent that's going to be there and hit and run. You know, we talk about that. Bad agents, we talk about them hitting and running, right? They get in there, they sell the policies, and you never see them. But again, we talked the other day about the ability to upgrade. Who's going to help that person upgrade? I've helped countless clients file a claim. Not that the claims are that hard to do, but you know, they get paid so much faster if the I's are dotted and the T's are crossed, right?
And you know what to look for.
And I know what to look for, and a good agent knows what to look for. You don't want an agent that was working at Home Depot last week. Nothing wrong with that, because I started without any experience. Everybody in this industry starts without experience, but you want to make sure that agent has something on the ball, let's put it that way.
Well, now I'm looking at these companies, and I want all these things sound really good. What about rate stability? You know, because I don't want to be every year seeing an annual increase in my premium on some of these ancillary benefits.
Right. You know, that really has to do with how that company wrote that policy in the first place. if they weren't very smart and they wrote it with benefits that outrun the premium, then you're going to have a problem. And that happens sometimes, especially with new entrants into the marketplace. They don't really count the cost. A major health insurance carrier, I won't name their name, that they introduced some voluntary benefits 3 years ago. They're out of that game already.
So they did not price it right.
They did not price it right. So again, there's a really just do some research online. The companies that raise their rates, there's probably a reason for it. I'd be very careful of that.
Now, of course, we did say yesterday that if they do raise rates, they have to raise it for everybody.
They do.
So,
they do.
So they're not picking on you.
They're not picking on you,
right.
absolutely.
Brand name. Now, I think about brand name. I think of like, I go to my medication every 3 months to go have and I buy the generic.
Sure.
But what about this? Do I need to be in the generic, or do you think, no, Steve, you're getting better deal with a brand name?
That's a great question. That's a great question. A lot of the brand names, there's a reason they're a brand name. They spend a lot of money on advertising typically. Kleenex versus tissue. Tissue still does the job, right? So when you're looking at these, sometimes the companies, again, you need to check them out very carefully. But a lot of times these smaller companies that you may not know the name, they're a little more nimble. They can be a little more innovative in the programs they put out, and they meet the marketplace needs faster quite often. It's like the difference between trying to turn a speedboat and a cruise liner, right? It's a lot easier to turn that speedboat.
So you're really, did I just hear you say you're kind of somewhat encouraged by smaller companies, maybe not known, maybe they're not the big brand name in the market,
right?
But they might be new enough where maybe they're even their tech interfaces between the company and the client sound like they're consumers.
Yeah,
sounds pretty good.
Absolutely. There's a major player in this space that, their head tech guy is like 72, and nothing wrong with 72-year-olds, but he's just not. That could be a challenge.
I used to say about us baby boomers, we invented the internet, we just can't operate it. That's funny. Okay, let's go to customer service, because we know, I have to tell you, I wouldn't mind waiting on hold for a half an hour if the music was better, okay? Number one, okay? But man, you're on hold for, sometimes these companies, you're on hold for a long time.
Yeah, again, the way to check that out is just call their 800 number, their customer service number, and see, do you get stuck in that phone tree of press 1 or, for this and 7. They're all going to have that to a certain extent, but yeah, when they tell you your time wait is 22 minutes or they'll call you back, that's kind of a signal to me.
You think it's better to just tell them to call you back and not hang?
Oh, absolutely, right, okay. Absolutely.
Listen, I'd love to be able to call, but if I finally get an answer, I said, I'm sorry, this has been a test of the consumer, due diligence service. If we'd have been buying a policy, we wouldn't have bought it from you. Right. Financial stability. Now we're in the Steve Savant zone. I watch at all the 6, 7 wire services, due diligence, due care, and I also look at the actual balance sheets. But for people, does this matter? Because your contract is only as good as the company behind it, and we're talking not only financial stability, but in your case especially, claims paying ability.
Sure. For the average consumer, that's not something they typically look at, right? They just don't. They take the word of their agent, and again, there's great agents, there's not so great agents. What I found is the carriers that don't have such great ratings, they don't put them on their brochures, right? So that always helps is if you notice the rating is good on their brochures, those things are regulated by the insurance commissioner's office. They can't lie on those. Those have to be approved before they can be used. So if it doesn't show up there, just a quick internet search can look at it. And we don't have time to get into what each one means, obviously, between AM Best and Moody's and all that kind of thing. But the reality is that there are some carriers that have great ratings, and there's some companies that don't have such great ratings. So,
in your experience, you've been in this game for a long time.
Yeah, absolutely.
If you have to, does it come down to a lot of times you're down to 2 carriers that are pretty much offering the same thing for the same price, but the differentiation in the ratings, one's higher rating. There's not even a question here. You're going with the the better company with the better rates.
Yeah, I am. But again, remember, a lot of times they only have one choice at work. So, if it's a reasonable rating, again, you're going to have to determine what reasonable is. I wouldn't shy away from it too much. But again, if you have multiple choices, yeah, absolutely. So that's more of a question for the employer than the employee.
I think that would be a huge liability to the employer to be offering somebody that has a tenuous rating and a bad balance sheet.
Sure.
I mean, that's an issue. All right, listen, don't forget to watch our next segment, Vetting Your Insurance Agent, on all these things we're talking about. Part 5 of our series on voluntary benefits. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.